Welcome to another episode of Quest for Twice. Today is May 15th. I'm going to cover another batch of companies that reported earnings recently. The first one is Mercado Libre. Just an update on a few important metrics. In the last quarter, the unique MELI active users exceeded 100 million people, up 24% year-on-year. So that shows its continuous momentum. For its unique fintech users, last quarter was 44.5 million, also a continuous momentum upwards. 73% of its total payment volume was off-platform in the last quarter. Now let's look at the numbers. So the chart on the top right shows its segment revenue. The bars are the commerce segment revenue, including both first party and third party. So we can see the commerce segment revenue rose significantly from 1 year ago. That's mostly driven by the fast increase in the commerce services segment instead of the product sales. That's good news because the service segment has a higher gross profit margin. Now let's look at the lines. So the line at the bottom is the credit revenue. You can see sequentially it actually declined slightly after holding steady in the last 3 quarters. On the other hand, the other fintech services continue to increase in terms of revenue. And the overall fintech revenue was increasing fast. So for last quarter, the gross margin was 50.6% comparing to 47.7% because of the lower 1P sales mix and better Envio's usage. As shown in the chart on the bottom left, we can see the same day and next day delivery as a percentage is roughly in line with the previous 4 or 5 quarters. That helps with the gross profit margin. So let's take a closer look at the fintech. The quarterly sales was $1.4 billion. The total payment volume was driven by digital account TPV was 12.7 billion in the first quarter, about half as the acquiring TPV. As a reminder, the acquiring TPV is associated with its commerce payments. We can also see that the digital account TPV was growing much faster comparing to the acquiring TPV. On the other hand, its credit growth has slowed. In the most recent quarter, its loan book was $3 billion compared to $2.4 billion 1 year ago. That seems fast, but sequentially, it's actually not growing so fast from Q4 last year. And we can see 2 years ago, the loan book was about $500 million. So comparing to the growth 1 year ago, this year's credit growth has decelerated significantly, which I think is good news because it's important to keep an eye on the credit risk, which is reflected in the interest margin after losses metric, which is shown at the bottom right. we can see the credit revenue was $536 million, a sequential decline from previous 2 quarters. The IMAL was $296 million, also a sequential decline. A little concerning is the IMAL percentage spread. It was 38.8% in the first quarter compared to 48.3% in the fourth quarter. So maybe the high margin in the fourth quarter was an anomaly because in the 2 quarters before that, the IMAL margin was less than 38% and as low as about 25% 1 year ago. So overall, nothing alarming. Just keep an eye on the credit quality and the loan losses. In terms of valuation, price over sales was 5.7, which seems to be a fair valuation. If we look at the take rate, in the most recent quarter, the commerce take rate was 17.8%, driven by the high take rate in its third-party business. If we look at the details, the ads revenue was $132 million in the first quarter, compared to $112 million in the third quarter last year, which shows its pricing power and the network effect of its platform. The fintech take rate declined slightly to 3.68%. That's driven by the slowdown in credit revenue growth, which I think is healthy. So my conclusion of a fast growth company with a wide moat and a fair valuation still stands. As Warren Buffett said, we want to buy a fantastic business with a fair price, and Mercado Libre fits the bill. Amazon also reported a very strong quarter. In its fiscal second quarter, it reported 14% underlying growth across all geographic regions and different segments. So to make it even better, its adjusted EBIT margin of 24.6% was an increase from 21.4% 1 year ago. That's driven by operating leverage of 53% and also positive business and world area mix and price cost increase, which demonstrates its wide moat and pricing power. The management also increased the full year sales guidance to up about 10% from fiscal 2022. Its backlog also increased to 6.9 billion, up sequentially from 6.6 billion in the first quarter. Amazon also closed the deal to buy National Instrument for $8.2 billion to beef up its discrete segment. We can see in the second quarter, its discrete segment had a revenue of $683 million. That's less than the measurement and analytical as well as final control segments. The discrete segment is related to manufacturing, including automobile and battery productions. So the rationale is sound. However, the price tag of 15x EBITDA seems excessive for its software business. The control system and software segment was fairly steady, and we see an increase for the Aspen Tech segment. That's because of the acquisition happened in the third quarter last year. So the year-on-year comparison is not meaningful. ATKR also reported a very solid second quarter. So just to set the scene, the long-feared price normalization has happened in the second quarter. The price declined significantly from 1 year ago. However, that was 30% offset by revenue from recent acquisitions. And also, the volume increased by 4% from 1 year ago. Importantly, the sequential comparison actually returned to growth. The second quarter total sales was 896 million compared to 834 million in the first quarter. The total EBITDA also increased from 264 million in the first quarter to 276 million in the second quarter. Looking at the two segments, the electrical segment revenue declined due to price decline. However, it was 40% offset by recent acquisitions. Its electrical segment margin also softened because of less PVC sales. On the other hand, its mechanical segment was really strong, with about flat sales compared to 1 year ago due to the volume growth offset price decline. Its margin 15.4% was also an increase from 12.9% 1 year ago for mechanical segment. So for the full year, the management also raised its guidance. Now the full year EBITDA guidance was $40 million higher than previous guidance, which was a step up from the guidance given at the end of last fiscal year. And third quarter EBITDA guidance was $250 million. So we can back calculate. The implied fourth quarter EBITDA would be $250 million also, which raises an interesting question, that is, what's the long-term stable EBITDA per quarter? In about 2 years ago, the management gave an indication that's about $600 million. But the price normalization is happening, and management is getting about $200 million per quarter for the rest of the fiscal year. So there is a high chance that the long-term EBITDA will be at least $800 million, if not more. The earning per share for the full year was also raised to $17.9 per share. Because of so much EBITDA as well as reduced working capital. So year to date, the CFFO was over $400 million. And capex used so far is $73 million and $83 million for M&A. And share buyback was $372 million. So Alcoa is generating lots of cash and return that in terms of share buyback. That's good for the long-term shareholder value because I believe Alcoa stock is undervalued. So its enterprise value is about 5.6 billion, and EV over EBITDA is about 7 using $800 million of sustainable EBITDA. It's not considering the near-term growth from torque tube and HDPE investment that will come online next year. And there are also multiple secular trends, including charging network, broadband, solar power, data center, and warehouses that will drive long-term growth. So the PE is about 7 using this fiscal year's EPS of $18. So my original investment case is still valid. Upstart also reported the earning. The first quarter revenue was 103 million, slightly more than the initial guidance of $100 million. That's because of a low transaction value of 1 billion. That's the lowest amount in the previous 7 quarters. However, the management gave a somewhat surprisingly optimistic revenue guidance for the second quarter in the amount of $135 million with a neutral EBITDA. So if we look at the quarterly revenue, it peaked at $310 million in the first quarter 2022, then declined sequentially to 228, then 157, then 147, and now $103 million in Q1. So $135 million is a significant bounce back. That indicates the management's confidence that the worst is over. Now the underlying business strength will generate growing revenue if the overall interest rate and liquidity condition is stable. So in the most recent quarter, the conversion rate was 8%, mostly because of a higher rate makes a loan less affordable and fewer borrowers being eligible for the personal loans. The auto segment had a revenue of $45 million compared to $57 million in the previous quarter. The management identified small balance personal loans for bank overdraft applications, as well as home equity loan as growth areas, which makes sense to me. We'll see how well they turn out. In terms of leading indicator, bank and credit union partners at the end of first quarter stands at 99. That's an increase of 7 from previous quarter and keeps its growth streak alive. So I would say the growth opportunity is still there. I don't have any update to the threats and opportunities to its business. So let's look at the valuation. So its price over sales is about 2.5 at $19 per share using trailing 12-month revenue. That's half as Equifax 5-year average and significant less than 13.6 at the end of 2020. So I would say the business is not out of the woods yet. However, its business model is not disproven just because of the significant stock price decline. This company has a lot of upside potential if its AI-powered credit model really works. On the other hand, we also discovered that it's highly reliant on the overall credit supply and the liquidity of the credit market. So it does have a lot of risk. I plan to add gradually to my position in Upstart because I need time to really understand if its underlying business model is strong and can withstand the test of time. This concludes the latest episode of Quest for Twice. Until next time, happy investing.